today we are going to talk about the inflation number that came out yesterday, why it is good news for the Bank of Canada, why it is good news for your mortgage. We are going to understand how the inflation number that came out affects the probability that the Bank of Canada will or will not increase interest rates and the knock-on effects on further Bank of Canada action leading into next year. We're going to discuss the June of 2024 date that we've been talking about a lot and the probability that the pivot happens. Welcome back, everybody. Thanks for tuning into our channel. Please, while you're here, don't hesitate to hit like or subscribe. Remember, we like that. If you remember all the terminology that we've been hearing in the media, it started with the pivot and the pause, and now we're hearing rates higher for longer. So all of these fun terms are all developed by somebody. I don't know who, haven't gotten to the bottom of that yet. But today we're going to talk about the StatsCan report. We're going to break it down a little bit, and we're going to try to understand what the inflation reading showed us yesterday, how it compared to August's number, why it's good news for us. And then we're going to dive into the probability and how the probabilities have been affected going forward for the Bank of Canada. So what the market is now anticipating based on that StatsCan report. We're going to try to do it relatively quickly for you. And then if you have any questions afterwards, just reach out to us or write a comment below. We'll know maybe where to fill in the blanks and where to give you more information afterwards. So here goes. The September CPI number was 3.8%. That is down. August was 4%, obviously. And that August 4% print gave rise to an increased probability as we looked at in the CDOR market that we were going to see an increase in either October or December, the two next Bank of Canada meetings. And now that's changed. So let's dive into this number. So 3.8% was a 12-month change for September of 2023. The StatsCan report gives us some nice numbers to look at. The first chart takes out gas. So we spoke a lot about this. Gasoline prices are heavily impacting our inflation numbers right now because the price of a barrel of oil is increasing. If we strip out the gasoline prices, if you look at this chart, the CPI number excluding gas is slightly lower than the actual CPI number, 3.7 as opposed to 3.8. And you can see going back to 2018, the meteoric rise of inflation in this market. You can see when it started at the end of 2020 and into 2021, Bank of Canada was telling us inflation's transitory. You can see that rise. You can also see how oil affected it in the dark blue line, right? You can see that the real peak in inflation, inclusive of the gas prices and how much of an impact they had kind of in the middle of 2022 on that number, that high print there, which is like in the eights. That was really scary for everybody. We definitely have a good trend on a go forward basis. And now that gas prices have relatively stabilized, we'll probably come off a little bit more. That'll help us on our top line inflation number. But there's also other components in there. There's a whole host of charts and information that the StatsCan report can pull out and put back into the CPI number that's helpful for us if we're looking at this data as if we are the Bank of Canada. And this chart 4 is really critical for that. You can see that all items in that CPI number leading us to that 3.8 number, it's a tough number. 3.8 is not what the Bank of Canada wants to see. But if we strip out gasoline prices and if we strip out food prices, and more importantly, if we strip out mortgage interest, that CPI number falls to 2.9%. 2.9% is actually our inflation reading if we take out mortgage interest. We know that mortgage interest is a direct result of these high interest rates. Now, it is super, super important that interest costs and borrowing costs remain high to affect change on disposable income and therefore consumer spending and consumer confidence. Make no mistake, the Bank of Canada wants spending to come down and confidence to come down in order for people to be buying less and driving up the price of things. And that is what is happening right now. People have less share of wallet to allocate towards anything other than interest. Unfortunately, food inflation is still a big component of this number. Although it is coming down and it will continue to come down, it is still affecting Canadians. The one thing that encourages me when I look at this report is that that number for all of the CPI, excluding gas, food, and interest, is really manageable. It's starting to get into a nice manageable range. And if we continue to see that trend come lower and lower, it's great news for the future of interest rates. When anyone cites a soft landing in this market, right, that we hear it all the time, right? Like the idea is for the economy not to get devastated by these high interest rates. It needs to feel like the economy is going to get devastated in order for us as consumers to pull back on spending, to lose confidence. And at that point, the Bank of Canada can come in and be more accommodative in their policies. That mortgage interest cost being a huge component is a good thing. And when we strip it out, the fact that inflation's falling pretty quick is even better. So we were super excited to see this number. Anecdotally, there's a chart here, chart 2, that shows the price growth in more than 5 major components. But you can see that like clothing and footwear, transportation, health and personal care fell down, recreation, education, and reading fell down. Alcoholic beverages, though, rather sticky there. Alcohol, tobacco, and cannabis is creeping up. So I guess maybe people are relying on that in order to help with the issues with consumer confidence. As things look more and more bleak in the economy, it's increasing the demand for those products. All in all, a great report, something that should have really encouraged the Bank of Canada, and I believe will allow them to hold rates where they are in October and again in December. Again, there's more of these reports coming out, right? We're going to get one every month. We're going to go through it every month. Understanding it is key. These reports are great. They break down into components exactly what people are thinking, and it shows us where money is being spent, and it shows us what prices are stickier than others. There's one more chart on a Globe and Mail article. Listen, similar information to what we were looking at from the StatsCan report, but also kind of cool. This shows us the CPI number if we strip out food and energy. So we know that food and energy are 60 basis points of that CPI number. It's crazy how when something goes wrong, you look so granularly at the numbers, right? Like I can't remember the last time I was, maybe university, that I was looking at the components of CPI and stripping things out and trying to see what the Bank of Canada was looking for. But here we go. Again, we know the 3.8 print, great that it came off from the 4% print last month. Also look at the 3.2 number, right? Like stripping out food and energy, we're at 3.2% in inflation. Take another 30 basis points off that and bring it to 2.9 if you take out mortgage interest. The components of CPI that we can't, we can control mortgage interest. We know that that's going to come off as soon as the consumer confidence and spending have more of an impact on the rest of those items. If you get out food and you take out energy and you take out mortgage interest, we're at 2.9%. Leave mortgage interest, you're at 3.2. That number is going to come down when the other components in that 2.9% CPI number start coming down. There's a moment here, and I really do believe it's coming in these next 6 to 9 months, where we see a real change and we go from saying the new normal, is going to be these incredibly high rates to, oh wait, maybe the new normal was bullshit. I know it doesn't feel like it right now, and it certainly isn't going to feel like it over the winter, and it certainly isn't going to feel like it leading up into the spring. If you're enjoying the show, please be sure to like, comment, and subscribe. Now, why don't we change tack a little bit and we'll talk about probability. This report, as soon as it came out, impacted the probability that the Bank of Canada was going to increase or decrease interest rates. It changed the probability. So if you look here, you can see the probability of a rate hike coming by the end of the year has reduced to 29%. Before this report came out, before that StatsCan report came out yesterday, we were well above 40%, close to 50% probability that the rates were going to go up by 25 basis points. And now you can see that that has changed dramatically. We're at less than 30% that rates are going to go up between now and the end of the year. You can see, though, there's still some inkling that another 25 basis points may creep into the market. And that is just the worry that another StatsCan inflation number comes in, or maybe an employment number might come in higher than we think. And that will kind of force the Bank of Canada to increase by 25 basis points. We speak about this a lot. The Bank of Canada is worried that inflation creeps into this market. If they don't do enough to stomp it out and it creeps back in, that's bad. They've already got this issue of confidence, right? People are worried. They think, maybe the Bank of Canada doesn't know what they're doing. They told us inflation was going to be transitory. It's obviously not transitory. Now inflation is in our economy. We got to get rid of it. The Bank of Canada doesn't want to lose confidence again, a second time, by pulling their foot kind of off the brakes too soon and seeing inflation come in. Again, this is great news. So, less than 30% chance that rates are going to go up by the end of the year. More important, we talk a lot about that June of 2024 number. Somewhere between June and September of 2024, there will be this pivot as the market is predicting. And you can see that because as soon as September 2024 prediction comes in, it's a 70% chance rates will be 25 basis points lower. I'm not saying that 25 basis point rate hike is going to change anything for consumers who are dealing with increased borrowing costs. The segment of the market that's getting hit the most are the folks who are between 35 and 55, people who are kind of in the prime of their borrowing. If you're 25 to 35, it's unlikely that you've taken on a bunch of mortgage debt. And if you're 55 and over, it's unlikely that you're still carrying a lot of mortgage debt. Some are just by factor of what's going on in the economy, but it's really that 35 to 55 where the consumer has just been crushed because they've taken on this debt. They're in this phase of their lives where they've bought a property and now they're sitting around saying like, I have to renew my mortgage. My mortgage was 2%. Now it's going to be 6%. A lot of consumers are deciding whether they can even keep their house. They're definitely tightening up the purse strings. Those people, that segment of which I am in, they're getting hit the hardest. 25 basis points less in borrowing costs is not going to change much. The prospect that interest rates will start to move lower from that point is helpful. I don't expect that we're going to see a whole bunch of confidence creep back into the market. And then as you continue to go down on that chart, you can see that all of the probabilities are stacked to the downside, right? Like everything is about rates continuing to come off until you get to the end of that chart, March of 2026, where it's about 60% probability that the rates will be 1.25% lower than where they are today. Now, these numbers change, right? Like yesterday I was looking at it and that March 2026 number was at about 90 something percent. You can expect one thing. This chart will be different every day that you look at it from now until March of 2026. This is just what the pricing is as of today's date. But as more and more readings come in that show consumer confidence is off, consumers aren't spending as much, that the employment market is weakening, and all of these things will continue to happen, the probabilities of future rate drops will become stronger. Eventually, we will likely settle at an overnight rate that's in the 3s or the high 2s. Right now, we're at 5%, right? Overnight lending rate is at 5. The prime rate is at 7.2. So maybe a more normalized place for us to be is in the 3s or the 5s on the prime rate. The goal for the Bank of Canada, the goal for Canadians is really to have a Bank of Canada that isn't so heavily involved in dictating monetary policy the way we've seen over the past 6-7 years for sure. These massive swings one way or another. This super accommodative policy we know will lead to inflation, especially if you couple it with fiscal policies that are inflationary, like printing money and handing them out to people. We speak to Canadian borrowers, right? So if you're a borrower right now and you're wondering what to do on a mortgage renewal that may be coming up, now's the time to start considering, depending on the difference in the rates you're getting quoted, now's the time to start considering a variable rate, because the probability that rates go up 25 basis points is low, still possible, and dependent on what other readings come out, but it's low. It's been getting lower. If that continues to happen, locking yourself into a 3-year fixed rate, which has been our advice leading into this period, may no longer make a ton of sense if we're going to see a period of time where the prime rate starts to drop 25, 50, 75, 1.25% lower than it is today. You won't be able to have access to the monetary policy stimulus that those rate drops are going to provide or are meant to provide the economy. I mean, that being said, like if you look back and 2 years ago, you took a 5-year fixed rate, you're laughing, right? You get 3 more years left. You can weather it out at a 2% 5-year fixed rate mortgage. Unfortunately, there are many people who, because of what's happened in the economy, need additional capital right now. If you find yourself in that group, you need to consider other options. We discussed that on a previous podcast. Matt, you can put the link to it here, but you need to start considering whether you need to borrow additional money or whether you need to sell in this market. Real estate is heavily impacted by interest rates. We are in a very dark period for real estate prices right now. It's not something that we didn't expect. And we've had real estate agents on here, and every single one of them, I've taken a bet that real estate prices were going to be lower. I'm not happy that we were right about it, but it's just a factor of supply and demand, right? The demand for housing is significantly reduced when its cost increases. And the cost of housing has increased significantly because the carrying cost has increased, because the interest rates have increased. As a result, real prices of those assets are dropping. Only thing that will catch them isn't going to be the influx of immigration that's happening right now. It's going to be a change in interest rates or a perceived change in how the monetary policy is going to behave going forward. But once we see that happen, more confidence is going to come into the market. If you're thinking right now, do I sell my house? I don't want you to cut it so close to the line as to say, like, I've got enough money saved and it can take me till June of 2024, but that's it. If that's your thinking, then maybe it does make sense to sell. In all likelihood, property values will continue to slide until that spring market of 2024, at which point we're going to see a turnaround. We're going to see more confidence in the market. We're going to see a lot of the buyers that are waiting on the sidelines come back in. And we're going to see a healthier real estate market. The other thing is we've been spoiled. For those of you that have real estate and have had real estate, you've been spoiled by seeing consistent increase in prices year over year, month over month. That is also not normal in a market, right? The market shouldn't really be behaving that way either. It should be a little more consistent. Right now, we're seeing a lot of that froth come off, a lot of uncertainty in the market. It's not a horrible time to be considering buying right now if you have the capital and if you think that you can afford the payments, because it will get better, right? And now's the time in the market where you jump in and you know that prices aren't likely to drop that much more and debt servicing costs are only going to get better. All of you that have been waiting for a nice variable rate purchase of your dream property, get ready. The other thing you should understand is it's very difficult to call the top or the bottom of a market. You know, some people say fool's errand to try to call the bottom of the market. We know we're at a very low point in the market right now. Could things get worse? Yes. Will they? Likely. Yeah. We probably see another 5-10% come off on real estate prices. But if you're in it for the long term and you want to acquire real estate, now's not a bad time. Thank you so much for spending this time with us. Try to keep it as concise as possible because I know you're busy. And if you have any other questions, leave them in the comments. If you want to see us talk about something else next time, leave it in the comments. And check out some of our other videos while you're here. And you can like those and comment on those too.